Hi, this is Steve Hutchinson with Hutchinson Family Offices, and I want to welcome you to a belated New Year. This is our first video since the New Year, and we're very excited about what we've seen so far. Although we were a little bit set back for the first couple weeks of the New Year, but we're starting to see things to develop as we would expect for them to. Generally speaking, though, we're optimistic about some things. We're a little bit continued about some other things. I'm going to discuss it in this video and share with you some of our ideas and some of our processes that we think that is important. First off, let's just talk about as we close the first month of the new year. We had a number of positive developments, mostly around the financial markets. The financial markets is measured by the S&P 500, and that's our benchmark for management. Posted a solid 1.79% gain for the month, which that's good. That's a very solid. And of course, if you're one of those folks who unfortunately spends too much time listening to the financial media, you'll hear or read that the Trump rally has stalled. Well, we're really not inclined to give much credit to political events such as elections for extended market moves. And it appears to me, or clear to us, that the financial market's ascent since October of last year seems to be well intact. So we're very comfortable where we are today as far as the financials are concerned. We do not believe that the markets are overvalued at this level. We think earnings are continuing to come in very good, and we would anticipate that would carry through at least until the middle of the year. Our managed platforms, mostly across the board, I rarely talk about our managed platforms, but it seems that we're mostly stepped up and fully indoctrinated. Our S&P 500 allocated platforms has outperformed the S&P 500, net of all fees, of course. This aside from our nominal performance, our managed accounts that were fully allocated achieved a lower level of volatility and risk. That's one of the key things we focus on, standard deviation and volatility. We continue to post what we call alpha. Alpha is a technical term for saying value added. We're probably 2 to 3 times what the market's alpha is, a lot of that being derived from dividends and excess incomes. And of course, other factors that are very important to us seem to be well in line and outperforming as well. The performance of our pure equity sleeve was really quite interesting. This is a part of our portfolio that we actually put nothing but companies into, no mutual funds or very few ETFs, rarely, until we decide to get a sector broken out. This was a large part of that equity sleeve is because of the way we tactically orient our allocations in the S&P 500. For instance, once the results of the elections were announced, our investment team led by Todd Walker and myself, we decided to allocate aggressively into the financial sectors. We were confident that if the new administration were to lift some of the regulations that were associated with Dodd-Frank, that we would see a $100 billion windfall in increased dividends and share buybacks, which would ultimately affect the shareholders of those companies. And so we are very positive on that, and I think this is one of the things we look at, and that's more of a tactical strategy, and I'll share more with you in future videos about that. Overall, we believe the financial market should continue to perform well. The optimism of lower rates and fewer regulations should add to the prospect of higher earnings. Our key indicator, which we call the 10-year Treasury note, has a positive indication at this level, and we also believe that the Federal Reserve can increase rates another 3 to 4 times, and the notes still remain well below our 3.25% target. So I can't really expand much on the financial markets other than optimism at this point. Now, let's take a look at the economy. Overall, our economy just continues to struggle. GDP came in well below 3%. I'm looking at an article here that just came out and said that GDP slows to a 1.9% growth. Bottom line is this doesn't bode well for the wages side of the equation. It doesn't bode well for expanded manufacturing sector or consumer demand increasing much above economic levels. We've got to see a 3 to 4% at a minimum GDP. And I would like to really see our GDP grow somewhere around the 4 to 5% range to really see some solid wage growth and see the consumers going back into the markets as we go from there. Employment seems to be on an upward trend, although real job growth remains low. I would prefer to see job growth come in on a 6-month moving average of about 225,000 new jobs per month. We're well below that. Last month we had 233, but the month before that we had 175. So we're not stable above that 225 number, and that's what I think we're going to have to see. That is positive for us when we get to that point. One positive sector, though, in the job area is the energy sector. We're starting to see job growth in there. It's been a solid performer, and we would expect that to continue. That coupled with a decline in government jobs because of the federal hiring freeze and expansion in other areas such as healthcare services, we should see the employment market start to pick up a little bit more. In the past 8 to 10 years, we've seen most of the job growth centered around government and education and low-wage jobs such as retail and food services. These don't really have much of an impact on our economy. Obviously in the first two, government and education, it's just a shifting of government taxes or government finances, if you will. We've got to really see the economy push a nominal growth of 4 to 5. On the legislation side, Dodd-Frank getting a little bit of breathing room here is going to be positive for the financials, and we've allocated accordingly. We're very positive about some of the other factors that we're seeing in the markets. Infrastructure spending looks very positive right now. The prospect for that, although I hope that it's paced a little bit better than just throwing a few $1 trillion out there to everybody. I would also like to see a little stronger situation as it pertains to overall development in real estate. Very concerned about the retail sector at this point right now, as we're starting to see retailers such as Macy's and other companies face a lot more pressure. But that'll do it for this month's video. I want to thank all of you for watching the video today, and if there's anything that we can do to be of assistance to you or answer any questions, please don't hesitate to give us a call. Thank you.